want to learn how to manage your own investments? Are you ready to stop paying investment management fees and start building wealth? The DIY Investing Podcast is dedicated to providing you with the knowledge, skills, and resources you need to be a better investor. Learn how to make investments through the use of fundamental analysis, mental models, and business management insights. Now, here's your host, value investing expert, Trey Henninger.
Hello and welcome to episode 20 of the DIY Investing Podcast. My name is Trey Henninger and I'm your host. In today's episode, I will be discussing the Keystone Habits of Investing that I believe you should follow if you want to become a better investor. These habits will help you to improve your investing process and ultimately improve your investing results. Brief reminder that this is a listener-supported podcast. If you'd like to support this podcast and help me to continue creating great investing content, please consider becoming a patron at diyinvesting.org/patron. My goal is to keep this podcast free of outside advertisements. In order to do that, I've decided upon a model that skips the middleman and allows me to receive support directly from you, the listener. My goal is to always provide you with value. Therefore, my membership program focuses on investment-based rewards that give you guides and insight into my personal investing process, the stocks I'm buying, the stocks I'm researching, and the insights that are coming away from that research. I believe this information can be helpful to you, and I hope you'll consider becoming a patron to help support the further production of this show. You can find out that information at diyinvesting.org/patron. So let's dive right in. Keystone Habits of Investing. This Keystone Habits series that I've been working on, I think is really critical because Keystone Habits have the power to influence many different aspects of your life outside of the specific habit that we're talking about. What makes a Keystone Habit is that by adopting one habit, you'll see changes that reverberate out further than that. You'll start to adopt new behaviors beyond that habit, and all of those behaviors together will work towards either the benefit or detriment in your life, depending upon whether it's a positive or negative Keystone habit. In today's podcast, I have 3 Keystone habits to discuss with you. 2 positive habits that I think you should adopt, and 1 negative habit that I think you should work hard to avoid. So first, I'll begin by introducing you to these habits, and then breaking down each one individually. So the 2 beneficial habits that I think you should adopt if you want to become a better investor are, number 1, read 1 10K every week, and number 2, always write out an investment buy thesis prior to purchasing shares of stock in any company. And the third habit that I want to discuss is a bad habit, and it's a habit you should avoid. And you should avoid checking stock prices every day. So, let's dive right into the Keystone Habits. The first habit that we're going to discuss is reading 1 10K every week. A 10K is a document, if you're not aware, you should be, because it's the most important document that individual companies produce concerning the investment merits of buying stock in their company. The 10K is the annual report required by the United States Securities and Exchange Commission, and it is published on the U.S. SEC website. These 10Ks are annual reports that companies have to publish about their financial performance, about the type of business that the company runs, the performance of all different aspects of their business, from sales, revenue. They publish cash flow statements, income statements, balance sheet, and this is a document is produced once a year, every year, for U.S.-based companies that are on the exchanges. So why is the 10K important? The first thing is the 10K is going to lay out basically 80 to 90% of all the information that you need to know before buying a stock. So it's not going to give you everything. But if you want, you can make investments solely by reading 10Ks about a company. Obviously, further research is always preferred, but what a 10K does is it gives you the key information that you need to know. So it lets you know what is the business of a company, kind of gives you the information you need to start analyzing the quality of that company's business. It lets you know how the business is performing. So you get the balance sheet, the income statement, and the cash flow statements to understand what is the money flowing in and out of the business. Is the business growing? You'll usually see prior reports as well. So they'll either report 1, 2, or 3 years of performance of the business in the 10K each year. So you kind of look at the 2 years back as well. And you're then able to get an understanding of, how is management being paid? Are there pension liabilities? What is the debt payments that are involved? Who are the key players in management? Were any stock repurchases involved? Did any dividends get paid out? Were companies acquired? And then you get to have a management discussion of any of those key points. But really the purpose of this document is for companies to have to disclose publicly to all investors on the same day the key information needed to make an investment in that company. What this means is the 10K is the most important document that you should be reading when you're considering buying a company as an investment. So why do I say read one every week? One of the key aspects of investing that you need to understand is that investing is not just a compound interest process, but also a compound learning process. The number one thing you need to do to get better as an investor is to constantly be learning about investing and constantly be learning new aspects of different businesses, different qualities of businesses, different performance metrics, learning more and more to provide a baseline of understanding that allows you to make good investments. You should only be investing in companies that are within your circle of competence. So if you want to increase the amount of companies you can consider, that involves learning, that involves growing that circle of competency. Reading a 10K is the best way to do that, because when you read a 10K, you're able to learn about a company in depth, and it can be a very concentrated activity. You can read a 10K in potentially an hour, but maybe 2 hours, depending upon your experience or your speed at reading and fluency of understanding. When you first start, it will take you longer to read a 10K as you learn different accounting terms, learn how the accounting works in business. But as you read more of them, you'll get better and better at doing this. And you're not only learning about that specific company, you're learning things that allow you to apply your learning from that company to other companies. So if you read about Coca-Cola, the 10K for Coca-Cola, that will help you in understanding Pepsi. So when you read Pepsi's 10K, you're going to see parallels between how those two businesses work because they're in the same industry. Both are producing sodas, bottled water, those sorts of things. And so when you learn about one company, you're going to be able to learn about the other. The economics will be similar. And as you read more and more 10Ks, you're going to start seeing patterns of things you like in companies and patterns of things you don't like in companies. And I think it's very important for you to do this in order to become a better investor, because the number one thing you want to avoid is buying a company that you do not understand. And if you're not reading the 10K on a company, you almost always don't understand it. And if you're not reading enough 10Ks about a specific company and its competitors or other people in the industry or related industries, then it's likely that you don't understand as much as you could or should about the company. So I think it's really important that anyone who strives to be a DIY investor, someone who's investing their own money, avoiding spending money on management fees, that they are reading the 10Ks of the companies that they invest in. Now, one of the aspects that is nearly always a concern when you're an investor is you're trying to find new investments. And so as part of that, you need to learn more about different companies. reading the 10K once per week is the goal I stated for a few reasons. One, it's enough frequency to build a habit. But two, it's also not out of reach for most people. A lot of people that choose to be DIY investors are not doing this as their full-time job. You're not an investment professional. Instead, you're someone that is trying to do this on the side. The key thing is that you want to have an activity that can concentrate on being the most value for your time. And that activity is reading a 10K, because by reading a 10K, you can exit that reading and have all the information you need to put a value on a company. Now, it's not saying that's the right value or it's an accurate value, but you can make an initial appraisal of the intrinsic value of a stock simply by reading the 10K. And that gives you a baseline for comparing to the stock price. So the key point is, if this is taking an hour of your time or 2 hours of your time, an hour or two is enough time that you can dedicate to investing on a week. So if you can just dedicate 2 hours to investing each week, the key point is you want to make sure that time is as valuable as possible. And the way that you do that is by reading this 10K. And the reason is because you're going to get more density of information from a 10K and very little noise compared to, let's say, reading investment articles or reading the latest news about the company that's being reported. And it allows you to focus in on the key information. Another thing is that you're able to concentrate this time into one specific area. So if you have some time on the weekend, you can do 2 hours, knock it out, and you're probably good for the week to have spent the time reading that 10K. It's also something that it eliminates the need to be thinking about investing every day and allows you to go on with your life. But it also allows you to know that you're constantly building a learning and backlog of companies that you have read about and that you understand. And it will help you to grow your understanding at a relatively good pace. So, if you think about it, there's 52 weeks in a year. So you're reading about 52 different companies every year. You're gaining a broader understanding very quickly. Over 10 years, you'll have read about 520 companies, and that's more companies than there are in the S&P 500. What that gives you is that very quickly, you will understand more about investing than most of the people who are doing this, because what you're going to do is you're going to grow that understanding at a very quick rate, and you'll be able to see different aspects of investments than you had before. So the other reason that I believe this is a keystone habit is that it will cut down on some of your bad habits. If you're reading a 10K, that's going to take some time. It's going to take an hour. It's going to take maybe 2 hours for you to sit down and work through the document. Some of these documents can be 50 pages long, 100 pages long, depending upon the duration of it. But it could be as short as 25. Just depends upon the company. But what it forces you to do is it forces you to sit down, dedicate the time, and it forces you to eliminate areas where you've been wasting time before. If you only have 2 hours to spend on investing every week, then you can't spend those 2 hours reading pointless news articles about investments or the latest acquisition target that occurred. You can't spend that time on CNBC wasting your time reading about politics or macroeconomic events. Instead, you're eliminating those bad habits and replacing it with a very good habit. And that's one of the key aspects of a keystone habit. So I think I've probably beaten that one to death, but I highly encourage you to start considering reading 10K every week in order to grow your investing acumen. So that brings us to our second keystone habit. Always write out an investment buy thesis before purchasing shares of stock in any company. So what do I mean by a buy thesis? An investment buy thesis is basically a short written summary of why you are buying a stock, what the value of the stock is that you think, or what you think the value of a stock is, and how you think that stock is going to perform. So what are you looking for? What are the reasons for buying it? Is this company a high quality company that you're going to hold for many years? Is this company that is a short-term trade because you think the stock price is low and it's about to double? What are your thoughts on the stock? Write it down, put it in writing. And This is very important keystone habit. And the reason is if you do this, you will be able to become a better investor over time because it will force you to eliminate mistakes. One, it has been quite often for me in the past where if I've written out a buy thesis that I was ready to buy a stock, by forcing myself to write out the reasons that I'm buying that stock, I've sometimes not actually bought the stock because I've realized that my reasoning isn't very good, or I've not done enough research, or I don't truly know enough to put an intrinsic value on the company. And if you don't know enough about a company in order to say, I believe this company is worth $100 per share, then you don't know enough to purchase that company's stock. And I think this is very important. The biggest mistake you can make here when you're just found a new company, you're excited, is to buy it too quickly. Because what you're going to do is when you find a company that you like and you find something new, you're going to come up with all sorts of reasons to buy it. You're going to have all these reasons to buy it and none of the reasons to sell it. You're going to have none of the reasons. You're not going to see the full side of things. And what writing out a buy thesis is going to force you to do is it's going to force you to look at the positives and negatives of that investment, positive and negatives of the company, and to write it out, put it on paper. Now, why are we saying put it on paper? And by paper, I'm being figurative. It does not need to be paper. You can write it on your computer, save it in a Word document, store it away for later. You can print it out, put it on your wall, whatever works for you. Myself, I write them in blog posts. And I highly encourage you to do this. If one of the best ways to keep yourself accountable to this is to start an investment blog and publish your buy thesis. Send it out there to the world. Have it there as a documented effort that you made to say, I believe Coca-Cola is worth $50 a share or whatever it may be, or I believe Coca-Cola is worth $30 per share. And this is why. State your reasoning. And even if you're wrong, you're going to learn something from it. Even if the investment doesn't work, you're going to learn something from it because what it forces you to do is at the end of that investment, when you're done, when you've decided to sell the stock, whether it be 1 month later, 2 years later, or 30 years later, you can look back at your investment buy thesis and say, did it perform like I thought it did? Was my decision making good? Because an issue that people have when you invest is that there is a gap between the process that you put into investing and the results you get out. Sometimes you can have a good process and a bad result. Sometimes you can have a good process and a good result. The opposite is also true. You can have a bad process and still get good investment results. Even though you would think that all the time bad process leads to bad investment results, that's not how it works in the investing world. The stock market can cause stocks to go up for no reason at all, and they can also drop for no reason at all. So in order to learn, you need to understand whether when you made money off of a stock, was it because you were right about your thesis, or was it because you got lucky? Was it something you didn't expect? These are all aspects of investing that you need to be able to understand, and you need to be able to look back on and do a post-mortem and say, was my decision making good? Because decision making and the process around your decision making is the only thing you can truly improve with your investments. You can't improve your results directly. You can only indirectly affect your results, and you indirectly affect your results by improving the decision making around your process. So this keystone habit of writing out an investment buy thesis before purchasing shares of stock in any company is all about improving your decision making. And what it's going to lead you to is it's going to lead you to avoiding bad decisions. You're going to avoid bad decisions because where you haven't researched a stock enough. You're going to avoid bad decisions by not buying stocks that you can't put a value on. And you're going to avoid bad decisions by not buying speculations that are based upon reasons that don't match your investing process. So everyone should have their own investing process. Mine's value-based investing, where you're buying stocks for less than your ascribed intrinsic value, with the idea that by doing that over time, you're going to end up with very positive results and earn a strong return on our money that while still maintaining safety. But other people have different investing philosophies. The key thing is you want your investments to match your investing philosophy and not make investments based upon someone else's philosophy or based upon reasons that don't match what you intended. Investing is driven very heavily by psychology, and it is important that you understand why you're doing the things you're doing, because if you don't, you'll never be able to learn from it. So I highly encourage you to always write out your investment buy thesis before purchasing shares of any stock in a company. This can be short. It can be a single sentence. It can be a single paragraph. It can be, I am buying Coca-Cola stock at $37 per share because I believe it is worth $50 per share. It can be as simple as that. And or it can be more complicated. You can say, I'm buying Coca-Cola at at $37 per share because I believe it's worth $50. I believe it is worth $50 because of reasons X, Y, Z. And Coca-Cola is a high quality company that I intend to hold for 30 years. And the results that I expect is an 8% return or a 10% return. And the more detailed you can make your buy theses, the more valuable it will be to you. And this isn't about being valuable to other people. It's about being valuable to you. Improve your decision making, and you'll eventually improve your investment results. So if you're interested in understanding how I write my buy theses, I am publishing my investment buy theses for the stocks that I buy on my blog. This is one of the member benefits available to patron members of the show. And if you go to DIYinvesting.org/buy theses or BUYTHESIS, that's buy thesis, you'll be able to see the buy theses that I have created for my personal investments. I write out the reasons that I'm buying stocks, the prices that I'm purchasing them at, how I think they're going to perform, what I think the quality of the businesses are, what I think the intrinsic value is. And I'm writing those things down, putting them down, and making them available to members of the show that choose to support us as patrons. So you'll be able to see all the information I have there, and I'm putting the buy theses that I have for stocks that I've bought in the past and currently, and I'm going to continue doing that in the future as I make new purchases, because I believe that this process will help me both improve my own investing, and I think it can also be useful for you as two things. One, ideas and areas where you can consider researching yourself, and two, as a good example of how to implement a positive investing process, and you can see how I write up my buy thesis in order to help you. So again, that's at DIYinvesting.org/buy thesis, BUYTHESIS. So that brings us to my third keystone habit for today, and that is a bad habit. And I think the bad habit that you need to avoid as an investor is checking stock prices every day. You should avoid checking your stocks and limiting the stock price checking that you do to as infrequent as possible. So I think once a week is the most frequently that you should check your stock prices. So my advice is that you don't check the price of your stocks more than once a week. Ideally, this would be outside of the time that the market is open. So something like Friday evenings after the stock market has closed, or checking it on Saturday or Sunday. But don't check your stocks when the stock market is open, because it will hinder you and it'll cause you to focus on the direction of the stock market and the stocks that are in your portfolio instead of the price of the stocks. Stock price is very valuable information. Changes in stock price are not. So the stock price, again, using the Mr. Market philosophy of Benjamin Graham, which I discussed in one of my prior podcasts. Let me look up the number real quick. Yeah, so that was episode 6, where I discussed my book review of The Little Book That Beats the Market by Joel Greenblatt, and discusses the mental model of Mr. Market. But the idea behind Mr. Market is very simple, and that is that the stock price is only helpful to you as a means to give you a chance to buy a stock or as a means to sell the stock. And that at all other times, the stock price of your stocks are meaningless. If you're not interested in buying a company or selling the stock that you currently own in the company, then it does not matter at what price it trades. Instead, you need to think about it as there's basically some irrational person sitting across from you that every single day is offering you a price. And some days they are irrationally optimistic and they offer a really high price at which they will buy the stock. And sometimes they are very pessimistic and they offer a really low price at which they will consider selling the stock. And that you get to choose any day that you want whether you want to accept their offer. And you can accept it to buy the stock or you can accept it to sell the stock. And the key thing is that it doesn't matter what the stock price is if you're not trying to buy and you're not trying to sell. All that, it doesn't give you any information. It doesn't give you any value. The value of the stock market is simply that you are given the opportunity to make purchases or make sales of stock. Not the requirement. You don't have to value your portfolio at the price that the market is offering. And you don't have to make purchases of stock at the price the market is offering. Instead, you should only use stock prices when they benefit you and they advantage you to improve your financial situation. What does that mean for the bad habit? This is why it's a bad habit to check stock prices every day. There's a lot of noise in the performance of stock prices. They go up, they go down, they go sideways. It doesn't tell you day to day how the business is performing. If the stock price goes up 1% of Coca-Cola tomorrow, does that mean that Coca-Cola has increased their profits by 1%? No. Just like if the stock price dropped 5%, it doesn't necessarily mean that Coca-Cola is making 5% less profits this year. Instead, this is just the buying and selling of stock between different investors who have completely different reasons for why they might do that. Some of those investors nowadays are computers, driven by a formula of whether they should buy or whether they should sell. If you focus on the stock price, it can cause you to make bad decisions because if you see the stock price down a lot, human psychology is such that you're likely to consider yourself having made a bad investment if you bought at a higher price, or it might make you think that you're wrong or feel sad or depressed. And these feelings can cause you to make the bad decision of selling when the stock prices are down. At the same time, if stock prices are steadily going up over time, then you might have greed at the idea that other people are making money if you have a lot of money in cash or you need to make investments. And you're likely to make the mistake of buying stocks when they're at high prices, higher than they're worth, because you're letting the stock price influence your decision making. Instead, you need to focus on making good decisions and having a good decision process. That's why I iterated the importance of an investment buy thesis before. Because if you have to write down the value of a stock that you believe a company is worth, and you have to compare that to the price, that can be helpful information because it says, okay, I believe the stock is worth $50. So if it's less than $50, I'm getting a good deal. And if it's more than $50, I'm not. If you focus on the fact that the stock price has fallen or the stock price has increased from $20 per share to $30 per share, that doesn't matter because if you're still able to buy it at $30, but you think it's worth $50, it's still a good deal. Just because it was lower before does not affect the value that you're still receiving. On the same token, if you believe a stock is worth $50 and it's trading at $80, then you have the opportunity to sell it for more than it's worth. It doesn't matter if the stock used to trade at $100 per share and you didn't make the decision then. All that matters is comparing it. What do I think a company is worth today compared to what is the price today? So what you need to do is divorce yourself as much as possible from the daily changes in stock market. Whatever you do, don't check your stock prices multiple times a day because then it's not going to give you any useful information. So I would say ideally, target once a month and use price alerts for stocks that you're interested in buying. So if you're interested in buying a share of Coca-Cola at $30 per share, then set a stock alert with your broker that says, send me an email when the price hits $30 per share. Otherwise, don't follow it at all. If you're not going to buy until it hits $30 per share. You don't need to know that it's at 38 or 40 or 80 or 60. None of those prices help you because they're not at the price that you have chosen to buy the stock. And if you can't make a choice in advance of where you would buy a stock, you don't yet know enough in order to be investing in that company. And so really, again, the key with this bad habit that you want to eliminate is to help you make better investment decisions. So don't check your stock prices every day. Once a week is likely the most frequent that you should consider checking stocks, but ideally target once a month and use stock alerts for prices that you would consider buying at and set them for your buy prices. Otherwise, you don't have to worry about it. As a DIY investor, as someone who's choosing to spend some time and is interested in investing as a hobby, you need to protect yourself from bad behavior. Because if you like investing, if you like the idea of making money through investing, it can very quickly and easily turn into gambling. And that's the idea where you get a rush from seeing stocks rise and you get a rush from making money. And if you're doing that, your mind is not in the right place because you're likely to be making bad investment decisions. Instead, you need to shift this to being relatively hands-off and focus on the stuff like reading 10Ks and writing investment thesis, which is actually going to help you make money, and less on the things that are going to cause you to make bad decisions like checking your stock prices. So if you're trying to sell a stock, set a sell price, consider either putting it in your broker or consider setting a price alert to alert you when you hit that price. And then you can make a decision at that time whether you still want to sell at that price. But if you look at the day-to-day movements of the stocks, you're going to be given lots of opportunities to make bad decisions. And we want to limit our bad decisions and we want to increase the opportunities to make good decisions. So that's why I've outlined these Keystone Habits. I hope you'll consider adopting them. I have found them valuable myself to read 10Ks, and I recommend reading them once every week. You should always write out an investment thesis prior to purchasing shares of stock in any company, and you can see my personal investment buy thesis at DIYinvesting.org/buy thesis. I'll also have a link in the show notes for this podcast. And you should limit the bad habit of checking stock prices every day. Once a week is plenty, and once a month is probably ideal. Thank you for taking the opportunity to listen to me today. I value your listening to this show, and I hope you'll consider becoming a patron. You can get the full show notes for this episode, including my outline for today's podcast, at DIYinvesting.org/episode 20. And if you have gained value from today's content, please consider supporting the show financially. I'm setting up multiple rewards within there to reward those of you who are supporting the show, and I hope those rewards will improve your own investment process by being able to see the insights into my own. Your financial support is what allows me to continue creating this free investing content without any advertisements. Thank you for listening, and until next time, stop paying fees, start building wealth.
Thank you for listening to the DIY Investing Podcast. Please visit our website and subscribe to our email list at DIYinvesting.org for guides, videos, and resources to help make you a better investor.
The DIY Investing Podcast is presented for general informational and entertainment purposes only. I have not considered your specific situation or risk profile, and I have not provided investment advice. The information presented on the DIY Investing Podcast should not be construed as investment advice. The views and opinions expressed on the DIY Investing Podcast are those of the participants and do not necessarily reflect those of the show's host or sponsors. DIY Investing, its producers, sponsors, and host, Trey Henniger, shall not be liable for losses resulting from investment decisions based upon information or viewpoints presented on the DIY Investing Podcast.